if you could come to the next slide.
Yes, sir.
Yeah. So the question before the Supreme Court, and this is the engineering analysis is just the lead party to the case. There are many parties because, as I told, software payment has been the subject matter of enormous litigation, and many parties were involved in this case. Engineering analysis was the lead party. So the dispute was whether payments for these software under 4 types of situations in that case, where the payments for these softwares were liable to tax in India and liable to TDS in India specifically, because these was mostly the TDS cases more than assessment cases. So the question was whether the payments for these types of softwares were liable to TDS, and the Supreme Court categorized the dispute before it in 4 baskets. One was and before, okay. Now, since Prakash ji has asked me to give a brief introduction of this case, I'll instead of going into the basketing, etc., let me tell you that that was the question, whether there would be TDS. Now, Supreme Court answered it in considering all the points raised by the revenue, and then answered it on the basis of the treaty, then answered it on the basis of the act, and then concluded by telling that since the treaty provisions are beneficial, on the basis of that provision, these payments should not be liable to tax. And since they are not liable to tax, there is no question of TDS. And since all these cases were relating to pre-2012 period when there was amendment of the law, there was no question of any retrospective application of the TDS provision, because that is not possible to do. So, in a nutshell, the case was that software payments of the types referred to in this judgment were not liable to tax because the treaties being beneficial did not consider these payments as software royalties, and since they were not taxable, there was no need of TDS. That was, in brief, the conclusion of the case. And perhaps this brief will give an idea of what this case is all about, and then we can venture into the nitty-gritties. So, Prakash ji, is that a fair briefing of the nature of the case?
Yes, sir. It is a fair briefing here, and you have rightly pointed out that there was a 3 stem of the case: one from Delhi High Court, one from Karnataka, one from AR, and you have rightly taken up, sir. Now, can I change the slide, sir, if you allow me?
Yeah. So coming to the nitty-gritty, Supreme Court categorized the types of payments into 4 categories. The first one was Indian end user purchasing straight from the foreign supplier royalty. Now, purchasing is a loose term. They were acquiring software from the foreign supplier. That was the first category. Second category was foreign supplier itself. Okay, I'll come to the second category. Let's talk about the first category. Here, the EULA, that is the end user license agreement, under which the Samsung Electronics company supplied Samsung software to Indian end user. And the nature of the EULA was that it was a non-exclusive license to install and 1 copy of the software on a single hardware. The Indian end user could make 1 copy for backup purposes. The software, it was specifically mentioned in the EULA, that is being licensed and not being sold. And end user was not permitted to do anything with the software in terms of copy or reverse engineer or work with the source code or modify or create derivative software, etc. All those were prohibited. And Samsung mobile device could be sold to the customer, even the end user could sell it to the customer, but the purchaser of the end the device, they also had to agree to the restrictions put by the EULA. So that was the first category. Now, category 2 was here there is a remarketer or there is a via media in India. the foreign software supplier is selling to a distributor of software in India, and the distributor is selling to the end user or another party in India. So here the case was with reference to IBM. So remarketer agreement providing for supply of software by IBM Singapore to IBM India. IBM India is the via media or the distributor. IBM India permitted to resell the software to end user or other remarketer. Software is again protected by foreign suppliers' patents, copyright, other than or in addition to remarketers' patents. This is very crucial because the software is protected, continues to be protected by the foreign suppliers' patents, even though the Indian distributor is selling it to the ultimate end users. Again, the agreement was non-exclusive, and IBM India's rights under this agreement were not property right. That was a typical clause in the EULA, that it not being property right, the remarketer, that is IBM India, could not transfer or encumber them in any way because they were not property rights. So this was a typical legal connotation of the EULA clause that was brought up. Then the third category, of course, there are some other facts in the second category itself. The IBM India does not own any right, etc., in the copyright in the software. Patents or copyright infringement suit against IBM India by any third party to be defended by IBM Singapore. This is also a very crucial point because IBM Singapore continues to own the copyright over here, and therefore if IBM India would face any litigation in India on copyright violation, the same would be defended by IBM Singapore and IBM India to market the software. So IBM IBM India having purchased or obtained that software, it would enter into end user license agreements with Indian end users. End user is authorized to execute the computer program at levels specified by IBM Singapore. And please note, IBM Singapore is specifying how the end user will use it in terms of number of users, millions of service units, processor value units, etc. The computer program is owned by IBM Singapore or affiliate and is copyrighted and licensed, and again not sold. End user has right to use the program to authorized level, make and install copies for that purpose, make backup copy. And there were the usual restrictions. End user was not allowed to reverse engineer, sublicense, rent or lease the program. The third one was, here the remarketer or the distributor itself was a foreign party. So the main source of supply was a foreign party. The distributor itself was a foreign party, and then the customer was in India. So Microsoft software sold to Indian end user by Microsoft Corporation, a foreign distributor. Here the EULA allows end user to install and use one copy of software on a single computer. Maximum 5 computers may be connected to the one for limited purpose. End user may store a copy on a storage device, example a network server. End user may not reverse engineer the software, that is the usual restriction found in in all the EULAs. All right and IP rights in the software are owned by Microsoft or its suppliers, and one copy of software may be made solely for backup or archival purposes. This is a typical restriction that is there in all the EULAs that are reported in the case law. Then the fourth one. Fourth one is software embedded in hardware. Here the contract was between JT Mobiles India and Ericsson Sweden for supply of mobile telephone system. Non-exclusive restricted license to JT Mobiles to use the software only for own operation and maintenance of the system. JT Mobile receives no title or ownership rights to the software. JT Mobiles not to make any copies of the software or part thereof. JT Mobiles not to license, sell, alienate in any manner or part with the possession of the software. And if any third party acquires the hardware system, the above license will be transferred provided the third party agrees to abide by the terms and conditions of the license, similar to what we have seen in the Samsung category 1. So these were the 4 pillars on which Supreme Court decided these cases, categorized these cases. Now, these being the facts, the question was anybody following this case would ask is, what was revenue's problem? What did revenue contend? Now, revenue contended that these payments should have been subjected to TDS in India. Now, why it should be subjected to TDS in India? There were a whole host of arguments, starting from, though I have not started with what would be the most the first argument. The first argument was that you should do a TDS and you need not worry about whether it is liable to tax under the treaty or not, because when you are doing a TDS, you should be governed by the Act, and treaty does not talk about TDS. Treaty is only about final taxability. So that was the first contention. Now coming to that was the first contention, but thereafter the revenue also did go into the taxability question. Revenue told that the scope of royalty definition as far as software payments are concerned have been enormously expanded by amendment by Finance Act 2012, and that too with retrospective effect from 1 June 76. And pursuant to this amendment, all these payments should be of the nature of software royalty. Now, specifically to draw your attention, they told that explanation 2.5, which deals with the definition of software, definition of royalty as far as software payments are concerned. It provides that payment for transfer of all or any rights, including granting of a license in respect of any copyright, is royalty, which covers all these cases. And specifically, it stated, the revenue contended that the phrase "in respect of any copyright," in respect of, needs to be given a wide meaning. Then, in course of arguments, the revenue also contended that there is an old circular of circular 152 of 1974 and another circular 588 of 1991, in which the finance minister's speech of 1990 was produced. That circulars, they explained the intent of the provision from inception. And explanation 42916, introduced by Finance Act 2012, retrospectively from 1st June 76, provided that the transfer of all or any rights in respect of any right, property or information always included transfer of all or any right for use or right to use a computer software. So this, they told, was expanding the scope of software royalty under which all these payments are likely to were getting captured, and therefore they should have been subjected to TDS. And the revenue followed up its argument by referring to severity notification of June 12, which provided that explanation 4 clarifies intent of the law from the date the section was brought into the Act. Section means the royalty section. So these are the tax law based contentions that revenue put up. The revenue also put up contentions on other matters, non-tax law based, but we'll continue with the few other tax law based contentions that revenue made. There it said that TDS provisions are distinct and exist apart from the assessment provision. So this was basically the first question, because these were all TDS cases. So they said TDS provisions are distinct and exist apart from the assessment provisions. DTAs are therefore not relevant at the time of TDS because the payers are not assessees. So for that contention, for that proposition, they referred to Article 30 of US DTA, which provides for separate entry into force date for withholding taxes and other taxes. Now, other taxes means, of course, assessment taxes. Withholding taxes, Article 30 gives separate dates for applying it for withholding purpose and separate date for applying it for normal taxation of the payments as income. They referred to Transmission Corporation for a portion which said that payer and assessee are different. Then they heavily relied upon Tilcom judgment, where it was stated that tax must be deducted whether the tax is otherwise payable or not, because it is there, it is written over there that any income paid will be subject to 20% tax, and therefore there was no scope to see into any treaty provision. Then they referred to India's reservation on OECD commentary, where they have India government has their OECD commentary, where India has capacity to put up its reservation and comments. There, India government has put up its reservations. And OECD commentary, to the extent conflicting with domestic law, must give way to the domestic law. So it should be domestic law which cover at least the TDS provisions. That was, in a nutshell, the revenues proposition. Apart from these typical tax law-based contentions, revenue also put up copyright law-based contentions. It tells, since adaptation of software could be made even for use on a particular computer, copyright is parted with by the owner. These cases come under Section 51B of the Copyright Act, thereby constituting infringement, hence parting with copyright is involved. And in other words, revenue told that if you use the software without permission, you are infringing the copyright, and therefore there is a copyright. What is the doubt about it? That's what revenue content. Then there is another section 52(1) AD of Copyright Act, which makes copying for non-commercial personal use as non-infringement, but copies made for commercial use amounts to infringement and therefore transfer of copyright. So on this basis, they told that even under Copyright Act, there is acquisition of right related to copyright, and therefore it is in the fitness of things that these will be called royalty. The payments will be called royalties. Next slide. So in a nutshell, I am trying to set up the basis from which the litigation takes off. The revenue.
Saurav sir, your audio is not, you are not audible, sir.
Is it audible now?
Yes, sir. Yes,
okay.
Sir. Can you, my request is that, can you keep the mic, please, mic nearer to you?
So, okay. So, to set the base for litigation, precise question of the revenue is consideration that the Indian payers paid to the foreign suppliers in these cases amounted to royalty on which the Indian payers would have deducted tax under Section 195. And the corresponding question that the relief sought by the payers was that these amounts paid by the Indian entities to foreign software suppliers royalty in the facts and circumstances of the case and in law. So this was the basic point of dispute in this entire case. Now, here I would like to take a pause and sort of speculate upon what sort of reasoning would have appealed to the Supreme Court in order to decide the case. The Supreme Court could have clearly told, and in a shorter version of the judgment, if assuming that were happening, they would have clearly told that the treaty defines the taxability, and this they have dealt with in in a part of the judgment, namely para 108. There they have clearly told that treaty is to be the determining factor of taxability. If the treaty makes it non-taxable, then that is the end of the matter, and we need not go into any further question. If it is non-taxable, there should be no TDS. And why there should be no TDS? Given that there was PILCOM, there could be a question. Now, they disposed of the question of PILCOM by telling that PILCOM is a case where they did not refer to taxability at all of the underlying payment. They referred to any income paid. Of course, the word income is there in Section 194E, but they told that it did not refer to taxability. Rather, they pointed out that 194E was similar to Section 193 and 194, where any payment draws taxability. But even in that, I have a slight discomfort, but anyway, we'll come to that. They told that 194E, which was the point in Pilcom case, that did not require taxability and it just straight away took you to 20% tax. So it was on these cases, these facts that Supreme Court decided Pilcom. And since 195 is different, therefore there was no need for referring to Pilcom. And then, since taxability has been decided on the basis of the treaty, it has been found that treaty provisions are beneficial. There was no taxability. Therefore, there was no need of TDS. The decision could have been as short. But what the Supreme Court did was, though it decided on that, but it also referred to and interpreted the amendments in the Act, and then went into various factors and various contentions that all the contesting parties had put up, gave its views and conclusions on each and every one of them. And then we have a big judgment, but the end point is that the treaty protected them from payment taxability and therefore there should be no TDS. Okay. Having said that, we now come to how does the Supreme Court proceed on the deciding the question of taxability under the treaty? If we take up a typical treaty, Prakash, is it possible to go forward by a few slides? Where,
yes, sir.
Further. No. Yeah, the next one. Yeah, here definition of royalty in the treaty. A typical treaty defines royalty inter alia as consideration for the use of or right to use any copyright in a literary work. Now, this is what the treaty tells: copyright in a literary work. And how is the word copyright to be understood? A copyright word is not defined in the treaty, and we are all aware of the classical Article 3(2), which tells that if any term is not defined in the treaty, then the party who is interpreting the treaty will have to refer to the domestic law of the contracting state in which he is situated and see the meaning as as contained in the domestic tax law of the contracting state. That's Article 3(2). Domestic tax law of the contracting state brings us to the Income Tax Act. In Income Tax Act also the word copyright is mentioned, but the meaning of the term copyright is not mentioned. And therefore we have no other alternative but to come to the special and specific act which deals with the subject, which is Copyright Act. And therefore it is very, very important to understand basic features of the Copyright Act in even understanding why the treaty protects these type of cases. So, Prakash, we again come back to the Copyright Act terms.
Okay, sir.
Yeah, so Copyright Act, the major provisions I have reproduced here. Computer includes an electronic or similar device having information processing capabilities. In computer program or software, as here, that's the relevant term. A set of instructions expressed in words, codes, schemes, or in any other form, including a machine-readable medium capable of causing a computer to perform a particular task or achieve a particular result. This is computer software. Author is the creator. Adaptation is in relation to any software, any use of such work involving its rearrangement or alteration. Literary work includes computer program. Next. This is a crucial section, meaning of copyright. The exclusive right subject to the provisions of this act, that is Copyright Act, to do or authorize the doing of any of the following acts in respect of the work. In the case of work not being computer program, though these are not, it's written not being computer program, but in subclause B it's stated that in case of a computer program, all these will be included plus something. So what are these? To reproduce the work in any material form, including the storing of it in any medium or by electronic means, to issue copies of the work to the public, not being copies already in circulation, to make any adaptation of the work, any of the above acts in relation to the adaptation of the work. And then clause B, next slide. And in the case of a computer program, to do any of the acts specified in the previous slide, and to sell or give on commercial rental or offer for sale or for commercial rental any copy of the computer program. Section 16 is very crucial. No copyright except as provided in this act. No person shall be entitled to copyright in any work otherwise than under and in accordance with the provisions of this act. So in other words, the law of the land tells that there cannot be any copyright in India other than under this act. Therefore, to understand the meaning of the term copyright in the treaty as well as in the act, we have perforce to refer to Copyright Act, and it's a very, very technical act, but there is no option. We'll have to understand this act and see and judge in the light of this act whether there is copyright involved or not. Then we can come to the other slides, assignment of copyrights, then mode of assignment. Section 30 is crucial. License by owners of copyright. The owner of the copyright in any existing work may grant any interest in the right by license in writing. This is the EULAs and all these. These are the typical licenses by which permissions by which the license is granted. It's a different matter that EULAs, as examined in the judgment, they did not grant any license. Rather, they only gave set up restrictions. But it's very, very crucial that the license should give some interest in interest or right in the copy in the software. Then only it is a license. Then certain acts not to be infringement. This is important. The making of copies or adaptation of a computer program by the lawful possessor of a copy of such computer programs and such copy in order to utilize the computer program for the purpose for which it was supplied, and to make backup copies, purely as a temporary protection against loss, destruction, damage in order only to utilize the computer program for the purpose for which it was supplied. This will not be infringement of copyright. That has been provided clearly, because otherwise nobody can use a software. If you tell that whatever software you purchase from the market, the moment you put it in your laptop, there is an infringement of copyright, then the software is as good as unusable. Therefore, this section is the one which protects the user of the software from copyright violation when he just purchases the software and uses it for its own purpose. Next slide. These are the rights of the owners, copyright holder against the person who have infringed the right, copyright right. Then next slide. So this I have told you in terms of why the reference to Copyright Act was relevant. Copyright Act was relevant because we had to understand the meaning of copyright. Under the law of the land, only Copyright Act is the only source from which we can understand the meaning of copyright. Therefore, the reference to Copyright Act is not only relevant, but it is rather the essential step without which we cannot move. The next slide. Now, in proceeding with this judgment, the Supreme Court, the court was referred to an AR ruling in the case of Citrix Systems Asia, where the AR held in the facts of that case that copyright is to be understood in terms of common knowledge, and it was not necessary to go into the law. Like briefly, Citrix Australia entered into software and hardware distribution agreement with Ingram India. Ingram India was non-exclusive distributor of Citrix software products in India. AR opined that DTA definition of royalty must give over to the common understanding of the term. So they were telling that the royalty meaning in the DTA has to be according to the common understanding of the term and not how it is defined in the DTA. AR also held that it need not be constrained by the definition of copyright in section 14 of the Copyright Act when constituting the DTA, which was clearly wrong because section 16 of Copyright Act clearly told that there can be no copyright except under this law. Next slide. So Supreme Court had occasion to deal with this AR ruling, and it held that any wider definition of the term royalty must be ignored and the more beneficial treaty definition must be adopted. Article 3.2 principle must also be kept in mind. The term copyright must be understood in the context of the statute which deals with it, which is the Copyright Act. The municipal laws which prevail in the contracting state must be applied unless there is any repugnancy to the terms of the DTA. And Citrix was therefore held to be not stating the correct law. This was very important because if we have a problem in understanding why we should refer to the Copyright Act at all, Citrix was a typical case study which had to be crossed, and Supreme Court did this in this way. Next. This I have already told that Copyright Act section 16 has to be the only source, and Copyright seems to be the only source. Copyright Act seems to be the only source from which to know the meaning of the term copyright. Next. Okay. Now, this hits up the, we have already seen the factual background. We have now seen the legal background in terms of the treaty at least. Now, in this context, applying the law treaty as well as in the context of copyright law. Now, after this, the stage is set for applying the facts, applying the law to the facts. And facts are what the EULA agreements, end user license agreements state out. They are representative of the facts prevailing in the respective cases. Now, applying the law to the facts of the case, the Supreme Court noted in all the EULAs, what is granted to the distributor is only a non-exclusive, non-transferable license to resell computer software. It expressly stipulated that no copyright in the computer program is transferred either to the distributor or to the end user. Distributor does not get the right to use the product at all. So there is no transfer of copyright right. Therefore, what the distributor pays is price of the program as books, either in a medium that stores the software or in a hardware where the software is embedded. Apart from this, there is no price that the distributor has paid for getting any right to the software, right to the copyright of the software. So that was the basic nature of the EULAs before the court. Next. Further common features noted by the Supreme Court of the EULAs, apart from the right to use the program by end user himself, there is no further right to sub-license, transfer, reverse engineer, modify, reproduce in any manner other than that permitted by the license. End user can only use it by installing it in the computer hardware owned by the end user and cannot in any manner reproduce it for sale or transfer. Thus, these EULAs are not licenses under Section 30 of the Copyright Act. Hello?
Yes, sir.
Yeah. So, these EULAs are therefore not licenses under Section 30 of the Copyright Act. Section 30 provides for transfer of interest in all or any of the rights mentioned in Section 14, whereas these licenses were only imposing restrictions. So how come it be said that there were some rights which were flowing into the purchaser? There were no rights flowing into the purchaser. The purchaser was given a software and told that you are restricted from doing A, B, C, D, E, F, G, H, all possible restrictions. There were no rights which the licensor, the purchaser had beyond perhaps using it for himself or selling it as a trade. Next. In most of the software litigation, rather in all, we are very accustomed to seeing a comparison with book purchase and whether there is copyright transfer in case of a book purchase. Here we have the Supreme Court settling this issue. Consider the left left column is about copyright not granted, and in the context of a book, English publisher sells 2000 copies of a particular book to an Indian distributor. Indian distributor resells them at profit. No right of distributor to reproduce the book and sell copies of same, and no copyright transferred by way of license or otherwise. This is the case of a book. In case of the book where there is a copyright transfer, how should it go ahead? What are the features? The features are that the English publisher sells same books to the Indian publisher. Indian publisher is given right to reproduce and make copies with the permission of author. Copyright has been transferred by way of license or otherwise. Indian publisher pays royalty for right to reproduce the book in the territory mentioned in the license. Here is a case where copyright has been granted, and the left-hand side is a case where the copyright has not been granted. So the left-hand side represents a sort of a trading arrangement. Book purchaser purchasing book from the main publisher and selling it to whoever needs it. There is no copyright transfer. Whereas if there is an Indian intermediary who gets copyright to make books, taking a master copy or taking, say, whatever form it may be, from the main publisher, making Indian copies and selling it to the Indian public, that is a transfer of copyright, and for that any payment that will be made may be characterized as royalty. Next. Now, this is a famous case which is frequently referred to, and in the context of software only. The State Bank, and it's a customs case though, but embedded in this is the question of whether there is a portion of it is royalty or not. So SBI imported computer software and manuals from Ireland. SBI contended that part of the price paid by it, which was called countrywide license fee, was royalty for reproduction of the software and was thus exempt from customs duty. The court noted the following features of the EULA. Software remained property of the supplier. SBI only permitted to use the software in its own centers for a limited period. SBI not allowed to reproduce the software. Reproduction is not equal to use, because use means use for my own purpose, and reproduction means parting of a copyright by the owner, some of the rights by the owner, and here no right was parted with by the owner. Therefore, SBI was not to copy the software save as may be strictly required for its own sites. So these were all the restrictive conditions under which SBI could use the software. Then the court said that if these are your restrictions, you had hardly any right. How come you say that what you are paying is royalty? So it is not software royalty that you have paid the purchase price only, and on which you will have to pay full customs duty. There was no exemption for anything that you are claiming as royalty. Okay. Now, having said all this, it may be a proper occasion to see the definition of royalty in software royalty in Treaty and Act. In Singapore Treaty, it is an exhaustive definition. Royalty means consideration for the use or right to use any copyright in a literary work. And the Act is telling, defining it in this way: consideration includes lump sum consideration except that generating capital gains for transfer of all or any rights, including granting of a license in respect thereof. Such transfer must be in respect of a copyright, and post 2012 amendment, transfer of all or any right for use or right to use a computer software. So this is the Act situation, this is the treaty situation, maybe a summarization at this stage of the analysis. Court then goes on to explain the the Act definition of royalty. What are the main features? There must be a transfer by way of license or otherwise of some rights in the copyright, of all or any rights mentioned in section 14b, read with section 14a of the Copyright Act. Some of the rights or all the rights that are mentioned in Copyright Act 14a and 14b. 14a, 14b of Copyright Act are the cornerstones by which one will measure whether any right has been transferred or not. In respect of means attributable to. because there was a question from the revenue that in respect of should be given a very wide meaning. It includes every sort of right. But Supreme Court tells that in respect of means attributable to the attributable to the software, and it relies upon an old Supreme Court decision to come to that conclusion. And then the Supreme Court points out that the comma after the word copyright in the Act is probably a drafting error, because copyright is always of a literary work or scientific work, etc. So what was the need of comma over there? And Supreme Court goes on to mention that this error was sought to be rectified in the DTC 2010. We'll have occasion to sort of discuss on whether this observation was correct or not, but we'll keep it for a later stage. Yeah, next slide. So, analyzing it further, the Supreme Court tells that pre-2012, there was not much of difference between the treaty definition and the Act definition of royalty rate, because treaty tells consideration for use of or right to use copyright, and Act tells consideration for transfer of all or any right in respect of a copyright. And in respect of, we have seen, has to be defined as consideration for transfer of any right attributable to copyright. So what are going to be transferred? Any right contained in 14A and 14B. Granting of a license would necessarily mean a license in which transfer is made of interest in rights in respect of copyright, and there should be parting with an interest in any rights mentioned in 14A, 14B. Therefore, there was no fundamental difference between treaty definition of software royalty and Act definition of software royalty, at least pre-2012 amendment. The next slide. Now comes the Act definition of royalty as amended by the 2012 amendment, and which the revenue claim was from 1 June 76. Explanation 4 is that is that crucial amendment, which tells that it brings under the ambit of royalty transfer of all or any right for use or a right to use a computer software irrespective of the medium. Just it. Explanation 4 brings under the ambit of royalty transfer of all or any right for use or right to use a computer software irrespective of the medium. Revenue put up its contention, as we have seen in the previous slides, that there were circulars explaining that this was the intention right from beginning, etc., from 76, etc. Now, Supreme Court made some pertinent points that explanation 3, which was there in the definition of this thing, in the treaty definition, in the Act definition of royalty, explanation 3 introduced the term computer software first time in 1991. So how come you tell that explanation 4 is relating to a period even prior to that, from 76, when the term software itself was unheard of in the Act? Then it tells the term computer software was introduced in Copyright Act in 1994. How come you tell that explanation 4 is defining computer software right from 1976, when it was unheard of even in the Copyright Act? Therefore, Supreme Court had no difficulty in saying that explanation 4 is only prospective. Now, there could be a question whether explanation 4 is really making any difference. Now, let us see what explanation 4 tells. Explanation 4 tells transfer of all or any rights in respect of any right, property, or information includes transfer of all or any right for use or right to use a computer software. Please note that it does not talk about transfer of all or any rights in respect of a copyright. In explanation 4, the term copyright is conspicuous by its absence. It talks about transfer of all or any rights in respect of right, property, or information. That includes transfer of all or any right for use or right to use a computer software. So it has not gone via the copyright route at all. It has told that transfer of certain rights will be considered to be, falling within the scope of this particular section. And then the question that arises in the mind is, does explanation 4 create a parallel definition of royalty where right in respect of a copyright need not be transferred? Any right transferred for use or right to use a computer software is royalty. Is explanation 4 doing that? That is a question which can naturally come to mind, and let us see what the memorandum has to tell on this. Memorandum tells, considering the conflicting decisions of various courts in respect of income in nature of royalty and to restate the legislative intent, it is further proposed to amend the Income Tax Act in the following manner. To amend 916 to clarify that consideration for use or right to use computer software is royalty by clarifying that transfer of all or any rights in respect of right, property, or information as mentioned in explanation 2 includes and has always included transfer of all or any right for use or right to use a computer software irrespective of the medium through which such right is transferred. Now, as mentioned in explanation 2, the portion I have highlighted is actually not a correct referencing, because in explanation 2 it is talking about transfer of copyright right, whereas in the memorandum they have told that as mentioned in explanation 2, which doesn't therefore really explain explanation 2 as it were. It basically correlates to main section 916, where there is a talk of transfer of right, property, information. And what explanation 4 has done is that anything relating to royal software is actually transfer of right, property, or information. That's what it has told. It has bypassed the royalty definition. It has bypassed the copyright question altogether. Next. Now, Supreme Court tells how it reconciles is that the expression as mentioned in explanation 2 in subpara 1 of the aforesaid memorandum shows that explanation 4 was inserted retrospectively to expand the scope of explanation 2.5. Here, as I have pointed out, right, property, information is not mentioned in explanation 2. And in any case, explanation 2.5 contains the expression transfer of all or any rights, which is an expression that would subsume any right, property, information, and is wider than the expression right, property, or information. Therefore, Supreme Court basically, I should say, doesn't give much importance to the question that explanation 4 has not amended the law really. It tells that the amendment is big enough to take care of the intention of the government. So it agrees with the revenues contention in that way that explanation 4 has really expanded the scope of the term royalty. Next. Now, one may have some questions on this particular way, the particular way in which Supreme Court dealt with this question, because as I pointed out, as mentioned in explanation 2 in the memorandum is wrong referencing. Explanation 2 mentions right in respect of copyright, not right in respect of right, property, or information. This last phrase is appearing in 916 main section, not in the explanation. Then Supreme Court referred to the wording of memorandum to accept the revenues contention that explanation 4 was meant to expand the definition of royalty. It held that all the rights is wide enough to subsume right, property, or information. The question could be raised that where the law language was pretty clear. Explanation 4 was referring to 916 and not explanation 2, where the definition of royalty lies. What was the need for going to the memorandum? Because the law was pretty clear that it is not referring to and is not being able to expand the scope of the term royalty. So why did you refer to the memorandum? Isn't it a fundamental rule of law that where the law itself is clear, there is no need of referring to extraneous aids of interpretation, that is memorandum, etc. So why did you do that? Well, I mean, that is, this is the case. Next. on a conspectus of all the facts and circumstances and the legal cases and the various case laws that were pointed out to it, the Supreme Court summarizes its view as follows. One cannot have a copyright right without the copyrighted article, but just because one has the copyrighted article, it does not follow that he also has the copyright. It's a very, very important and profound statement. I may have a mobile phone which has thousands of softwares. I do have the mobile phone, but I do not have copyright in the software. That is a very, very fundamental and profound principle of law. Copying the program into the computer's hard drive or random access memory, the previous slide. Yeah. Yeah. Then copying the program onto the computer's hard drive or random access memory or making an archival copy is necessary to utilize the program. And right in relation to these acts of copying, when they do no more than enable the operation of the program by the user, should be disregarded in analyzing the character of transaction for tax purposes. Also a very important observation, because I have to copy the software, otherwise the software is useless. Now, if you tell that moment I have copied it, I have violated copyright law and I have actually got copyright, then the computer softwares cannot be used. Then in every case, there will be a software copy. Parting with copyright entails parting with the right to do any of the acts mentioned in section 14 of Copyright Act. And it is not sufficient to tell that, yes, you have purchased the software, you have got some right. What are the rights you have obtained? That has to come from section 14A and 14B of Copyright Act. That is the cornerstone by which to judge whether you have got the right in the copyright or not. Next. License from a copyright owner conferring no proprietary interest does not entail parting with copyright. It is not a license issued under section 30 of the Copyright Act. It makes no difference whether end user is enabled to use the computer software that is customized to specification or otherwise. Other words, it doesn't make any difference whether it is bespoke or it is shrink wrapped. A non-exclusive or non-transferable license merely enabling the use of copyrighted product does not convey rights of 14A and 14B of the Copyright Act and is not a license under section 30 of that act. And right to reproduce and right to use computer software are different. The right to reproduce amounts to parting with copyright, and the right to use in the context of non-exclusive end user license agreement does not amount to parting of copyright, and therefore the payment therefore cannot be software royalty. This is what Supreme Court summarizes even under the Act. So now the Supreme Court is on the verge of the decision that in all these 4 categories of cases that you have brought before me, I have found that you have not got the right. Actually, the right has been kept by the supplier. You have just got some restrictions to do some very minuscule copying work for your own purposes, or just to trade the software to other end users. But you have no right to reproduce, no right to make any adaptation, no right to go into any research how to better the software. So what right are you talking about? So what license you have got is not a section 30 Copyright Act license. It is just a restriction. And since you have not got any right of 14A and 14B, therefore the payments for these are not software royalties. Could it be said that they are not not software royalties even under the Act that is read with explanation 4? Well, there is, in my humble view, a gray area in that, because does explanation 4 have the effect of telling that anything relating to software is royalty? Well, at least the structuring of the law in the way it has been done does not seem to suggest that. But at least under the treaty, the Supreme Court has been able to establish that there is no right which has flown into you. And since no right has flown into you, there is no copyright, and there is no copyright, therefore it is non-taxable. And if it is non-taxable, what about the question of TDS? Now, the years concerned were pre-2012. could TDS have been made on the basis that the amendment was retrospective? Supreme Court answered that it was not possible for payer to do TDS at the time of credit of payment because the change law was not actually and factually in the statute at the relevant time. Refer to two legal maxims, the meaning of which is that the law does not demand the impossible, and the other meaning is that when there is a disability that makes it impossible to obey the law, the alleged disobedience of law is excused. Hence, payers could not be visited with the consequence of assessing in the court. So this was the summary of the way in which Supreme Court is now about to pronounce its sentence. Next, this thing. On treaty interpretation, why should it go by the treaty? Because the revenue made a spirited attempt to tell that on TDS matters do not go by the treaty. Here the Supreme Court tells DTAs have to be interpreted liberally with a view to implement the true intention of the parties. When treaty definition of royalty is modeled on Article 12 of OECD Model Convention, it is relevant to refer to the OECD commentary. It carries persuasive value. Many occasions where Supreme Court has referred to OECD commentary, example, these famous cases, Azadi Bachao, Formula One, E-Fund, etc. And when the revenue told that I have reserved my right, etc., there it told that merely making position with respect to OECD commentary does not alter the DTA provisions unless the DTA is amended after bilateral negotiations, because everybody knows what is the revenue's position. The Revenues Council is telling that you have reproduced that position in your reservations to the commentary, but how does it matter? Once it has been put into the treaty, it is for the court to interpret it. The court interprets it on the basis of the treaty language, and there anything in terms of reservation, in terms of not agreeing, etc., put in through any other document, that is of no relevance in enabling the court to interpret the provision. So this is how court dealt with the with the contention of the revenue, that it has made its reservations. Next. So with this, the Supreme Court hereby pronounces its verdict, which is that the payment in these cases before it did not constitute royalty based on treaty definition, and there was no obligation to deduct tax at source. Why there was no obligation? Because 195 refers to income. Unless there is income, there is no TDS obligation. There was no income because the treaty protected it, and since treaty protected it, there was no need to deduct TDS. So this was how the Supreme Court came to its answer. Now, while this is in brief how the Supreme Court arrived at what it arrived at, there could be questions of why did it have to refer to memorandum in terms of while interpreting explanation 4? Was the law, plain reading of the law, not clear enough? That is a question. Second is that this decision is applicable to shrink wrap software as well as bespoke software, that it has been explicitly clarified. The payments have been held to be not royalty. The question whether any of them were fees for included service or technical service was not before the court. Therefore, it is very important to keep in mind that this decision does not help in giving a sort of carte blanche that all payments for software, wherever there is no transfer of right, are not royalties. They are not royalties, but it's not that they are not taxable. There is a possibility that some of them may qualify as fees for included service or fee for technical service, in which case they become taxable anyway, even if they are not royalty. Next. Okay. The Supreme Court specifically told that the comma after the word copyright in the domestic law is some sort of a drafting error. But our research shows that most of the Indian laws on these progressive topics are coming from the Australian and South African legislation. We refer to the Australian law Income Tax Assessment Act of 1936, and it was found that similar using wording and comma usage is there in the Australian law. There is a comma after the word copyright. And the logic is that copyright itself is something which is explained elsewhere, it is not necessary in the Tax Act to tell copyright in respect of what. Copyright is copyright. It could be for software, it could be for literary work, it could be for any cinematographic film, etc. So this comma might not have been a drafting error. Okay. Then in para 54, the Supreme Court has commented that section 195 does not apply to non-resident pair, which perhaps the law itself is clear on that. It does apply to non-resident pair. Then it has told that section 9 refers to non-residents only, which perhaps is also, there are there are cases where it has been held that section 9 applies to residents as well as non-resident taxpayers. One very important aspect Supreme Court has told is that the treaty is an alternative taxing regime. It has clearly stated that it is not the right way to proceed on the basis that in respect of any payment, I first exhaust my analysis on the basis of Act, and if only there is a taxability under Act, I come under the treaty. Though it goes into the same conclusion, but it tells that you go straight to the treaty. If you find that it is not taxable, then it is end of the matter. The Act is not there to impose a tax, where treaty itself has exempted it from tax. That's because of 90 subsection 2. And there is a bit of analysis on that particular topic in the next slide. And the Supreme Court referred to India-Morocco Treaty, but telling that Morocco Treaty is written on the basis of OECD Model Convention, and therefore OECD commentary should be referred to in understanding how these treaty clauses are to be interpreted. There, perhaps the court missed out that in Morocco Treaty, payment for software itself is considered as an independent item of royalty, and it is not required that it should come via copyright. So the reference perhaps was not right. And recently, we have come across a case where courts in other parts of the world are becoming very sensitive to usage of OECD commentary and telling that only if the treaty provision is a verbatim reproduction of the OECD Model Convention should we go into the commentary of OECD. If it is not a verbatim reproduction, we should not see OECD commentary. So perhaps this is something which will come up in the future. But in this case, of course, India-Morocco was not an issue, and India other treaties were issued. And those other treaties were really very close to the OECD Model Convention. So the reliance on convention was not wrong. Next. So this is something on an treaty and alternative taxation regime. This thing became very famous with the Motorola judgment of Motorola Delhi Special Bench Tribunal judgment, where they told that treaty is a alternative taxing regime. It is not a exemption regime. There also there is a theory that if it is an alternative taxation regime, where is it imposing a tax? Treaty does not really impose a tax that way. Treaty tells that a tax revenue is to be shared between two countries in respect of these items. That's all. Whereas an Act does go beyond that, and therefore Act is really the taxing regime. But the theory is that treaty could be an alternate taxation regime. That was held in Motorola, and later on in the Birla Corporation judgment, where Honorable Member Mr. Pramod Kumar did a lot of explanation on why it should be alternate mechanism and not to be seen first exhaust the domestic law and come to the treaty. It's not that. Now, next slide. Now, just the first para, of course, is very illuminating, and therefore one could just read that. To examine taxability of a cross-border income in a source tax jurisdiction without first establishing the right to tax by the source jurisdiction is like putting the cart before the horse. Therefore, before proceeding to consider taxability of a non-resident covered by provision of tax treaty in terms of provisions of domestic tax law of the source jurisdiction, it is useful to first check whether source jurisdiction has a right to tax that income at all. It is therefore preferable to follow the approach of first examining whether source country has a right to tax a particular cross-border income, and in case the right is established, to examine under the domestic law. To provide whether the taxation of such an income, and if so, to what extent and what manner. There are of course literature which support the domestic law first approach, and then Supreme Court has really supported the treaty as an alternate taxing mechanism approach. There could be interesting implications under that, though not many have come to light. For example, India-Netherlands treaty does not have an other income article, and therefore it is possible that some peculiar items of income are not falling in the treaty at all. If it is not falling in the treaty, it doesn't get taxed. And because I am supposed to see only the treaty and not the domestic law, so it doesn't get taxed. Could be an implication, but not much material at this stage. Now, this is how the Supreme Court decision has panned out. If there is a time, perhaps one could take a brief comparison with the Australian law, which covers more types of cases like software as a service, etc. But that then depends upon Prakash, whether there is time or there are other speakers also. Maybe we could have this later.
Sir, we are already, sir, 6:47. So I will request you that if we can finish this presentation and we can take some question answer here, or then it will be, and after that we can go request Richa ma'am to continue here. Okay, so shall I remove this PPT, sir, and or shall we take the question answer, sir?
Yeah, I think let that be done.
Okay. So, is there any, sir? Okay. Now, I have received some of the questions, sir, and after that, I will request to this one, sir. Few questions are there, sir. Can you just briefly explain the doctrine of first sale, which is the Supreme Court has discussed in detail, sir, in this case?
I'm sorry, the doctrine of first sale is coming absolutely from the copyright law. And though there has been elaborate discussion in the judgment, but the end of the doctrine of first sale, that discussion is the culmination of the discussion is not giving anything different from whatever was referred to in the tax law. So I am sorry, I cannot tell anything on doctrine of first sale because it's purely copyright law, and it's not to my understanding at least, and also as it's seen in the judgment, not much really has flown in from there, though there was reference to it.
Okay, sir. Sir, another question is that, sir, under the significant economic purchase, expansion 2A, right, which has come effective now, we say the downloading of the software. So if there is a downloading of the software, then it will create a significant economic purchase of a foreign company in India. Now we say that earlier there was the issue that whether the downloading of the software will be also come into the royalty also. Right. So can you just please explain the interplay between the 916 expansion 2A after and the SCP expansion 2A, which talks about the downloading of the software, and how to interpret, because it may happen that if the downloading of the software if go more than the threshold limit, there can be some P issue that can also come, and then how to resolve this issue, sir?
Yes. See, that has definitely created overlap, because downloading of software, if we go by the Act situation, the Act is wider in meaning, and therefore downloading of software will definitely amount to royalty, on which there will be a 916 taxation. At the same time, it tells that if the amount of payment is more than 2 crore, then it will cause significant economic presence, and which is like a business connection, and there will be attribution to the business connection. So which is more specific and which is general? That is a basic question. There was case law like Madras High Court, Pope's Vulcan, which told that in context of 917, 916 versus 911, 916 or 7 is specific, and that will prevail over the general, which is 911. Here also, if those judgments, since those judgments are still standing, it has not been done away with by Supreme Court, perhaps one can tell that 916 and 7 are more specific and will have to be given precedence over 911. But the question is not free from doubt. And at the same time, even in a treaty situation, you have that where you are paying royalty, but there is a fee, then it will be taxed like a business income. So it's ultimately going to that route only, where fee is not set up by presence, but by the amount of sale. So it is quite possible that assume that the treaty is also like that. There, then you will have to tell that, well, there is a fee and therefore it has to be taxed like a business. So long as the treaty does not have it, then we need not be dealing with this question. But yeah, I mean, I appreciate the queries. Indeed, there has been an overlap created by this.
Sir, there's another question that is coming, sir. The question is that the definition of the literary work as per the section 2.0 of the Copyright Act says that the literary work includes computer program,
right,
table compilation, including computer database. So the computer database is a part of the literary work. Now, if you go to the equalization levy, it talks about the specified circumstances. It talks about the sale of the data or the sale of the downloading of the data here. Right. So the question is that how to understand the interplay between the 916 and the equalization levy here under these circumstances, sir.
Yeah. So I think the way or the only way to proceed could be first to analyze it in terms of the act, whether it is a royalty, payment for database. Is it a royalty? If it is a royalty, then it is not subject to equalization levy because of the amendment done in the recent. So that way, perhaps it makes a distinction between what is liable to equalization levy, is liable to the act, the Income Tax Act. Having said that, use of database, etc., these are all definitely forming part of, at least so far the revenue has contended that these are all forming part of royalty. So that itself takes it out from the purview of equalization levy. So there also it's overlap. Beyond that, I don't have anything to say at this stage.
Okay, sir. With this, I would like to hand over this to Sir Prashant, sir. Sir, is there any questions that you would like to, sir? And your point, sir.
Sir, my question is only one thing, that this decision, how it will impact the already withholding taxes paid by the Indian taxpayers, and whether the foreign tax non-resident SSEs would be able to claim any refund out of this?
Saurav, sir?
Yeah, I'm just thinking what could be the mechanism. Now, if a Supreme Court has decided after 20 years, then and I have paid TDS. So if I have done TDS, can I claim refund of TDS? No, there is mechanism for claiming refund of TDS, but that comes through a circular. And then it tells that if the contract has been cancelled, etc., you can claim refund of TDS. And then TDS will be paid after deducting any other direct tax dues you have. But I doubt whether, I don't think there is a time gap mentioned over there. So perhaps under that circular one can try. And in terms of the taxpayer himself who has suffered tax because he offered it to tax as royalty, then I am not sure there could be these provisions of section 150 under which one can try to tell that since this is a Supreme Court decision which may have come after even 20 years, then why should it not be allowed as a refund? Otherwise, what is the recourse that is available to me? There, the Supreme Court decision will be rendered not of any use if I do not get a refund. And how come the government sit on a tax which it was not entitled to?
So the question would arise that in case of where the appeals are pending before the CIT appeal or before the tribunal, can the non-resident SSE as well as the resident SSE can raise an issue which is a fresh claim? And what could be the possible arguments in favor of those claims?
Yeah. So this is an area perhaps we have to study a bit. So right now, I mean, I don't have much of an answer on this. Perhaps maybe as time goes on, we will be able to do some more study and then see.
Okay, sir. With your permission, sir, Chairman, sir, can we invite the next speaker? Next speaker,
on the next, yes. Very fascinating decision.
Yeah.
Please proceed, sir.
Welcome, ma'am. Your screen is visible right now. Richa,
Yes,
ma'am.
Prakash. Yeah, Prakashji. Can we start now?
Yes.
So after this illuminating session by Saurav, I think he's put the benchmark so high. So I'm a little scared when I take this up. But anyhow, I'll gather the courage and start off with this one. So this is an interesting decision of the Delhi High Court, which has come, around a time when dividend has just become taxable, when the DDT regime has just gone away. And these questions were actually cropping up. These questions were actually coming to us in various clients, that how do we deal with a situation like this? So an interesting decision. Let me just quickly cover the facts of this case. So what has happened here in this case is that Concentrix and Optum, these are two entities which are tax residents of Netherlands. They had 100% subsidiaries in India. And these, once DDT was gone and the dividend becomes taxable, these subsidiary companies had to do a tax withholding while making payment of dividend to these parent companies. Now, as per the India-Netherlands tax treaty, the dividend rate is 10%. Now, the assessees, they submitted an application under section 197. And however, they relied on the MFN clause, which is there in the India-Netherlands tax treaty, that's there in the protocol, to say that in their case, a rate of 5% is applicable. The tax authorities, however, they disregarded this request and they continued with the tax withholding rate of 10%. As a consequence, the assessees, they explored the writ remedy before the Delhi High Court. Next slide, please. So before we move further, just let's have a quick look at what Article 10 in the Netherlands Treaty talks about. So it says that when there is dividend paid by a company in India to a resident of Netherlands, it may be taxed in Netherlands. However, it may also be taxed in India, but if the beneficial owner in this case is a tax resident of Netherlands, then the tax cannot exceed 10%. So this is what the clause here says. If you go to the next slide, this is what was being relied upon by the assessee to say that in their case, 5% rate is applicable. So this is the MFN clause, which is there in the protocol. And what it firstly says that this particular one was actually notified along with the main DTA, and it says that it is an integral part of the convention. I'll just read through this entire thing because this will help us understand the case in a better fashion while we go along the submissions of the department as well as the assessee. So it says that if after signature of this convention under any agreement between India and a third state, which is a member of OECD. So that's important to take note of, which is a member of OECD. India should limit its taxation on source of dividend, interest, royalty, FTS, or payments for use of equipment at a rate lower or a scope more restricted than the rate or scope provided in the Netherlands TTA, then as from the date on which the relevant Indian convention enters into force, the same rate or scope would apply in case of the Netherlands treaty. So to take note of it again, enters into an agreement with a third state which is a member of the OECD. India enters into another agreement with an OECD country, and it becomes effective from the date on which this convention with this particular state enters into force. So these are the important points from a literal reading of this. Can we move on to the next slide, please? So what the assessee here contended was that they said that in their case, the 5% rate should be applicable. They said that India has entered into DTAs with other countries which are members of OECD, and therefore lower rate or lower scope would be applicable. And they said this would apply automatically. And they said that no further notification is required because, as I read in the preface of the protocol, it says that this protocol is an integral part of the convention. In this case, things are a little better because the protocol also got notified along with the DTA. In several cases, that doesn't really happen. But in this case, we are on a better footing as such. Now, the reasons cited by the tax authorities were that there was no notification. This the assessee sought to disagree with, and he said that in this particular case, this is part of the integral part. It got notified along with it, so you cannot take a plea that a further notification is required. So they also, in this case, relied on the Styria decision of Delhi High Court. What they said that the way this protocol is worded, it is a self-trigger. There is no indication that it requires some further consultation or another notification to be put forth. This is a self-trigger. It is on a self-trigger mode. The next one, please. Revenue, on the other hand, contended that a bare reading of the MFN clause would show that a lower withholding rate would apply only when India enters into a country which is a member of the OECD at the time of execution of India-Netherlands DTA. Now, there are three aspects here, three dates of importance. Should that country, for example, let's take the case of Slovenia here, should it be a OECD country on the date when India-Netherlands treaty was entered into? Should it be an OECD country on the date when the Slovenia treaty was entered into? Or should it be an OECD country at the time when the payer is actually making the payment to the Netherlands entity? So the tax authorities, they put forth that these are three DTAs that the assessee is relying on: the Slovenia, Lithuania, and Colombia. Now, the date of execution, if you see that in these cases, the treaties were notified, for example, in case of Slovenia in 2005, but it became an OECD member subsequently, say 5 years down the line in 2010. Similarly, Lithuania, if you see, 6 years after the notification of the treaty, it became an OECD member, and again a 6-year time frame for India, Colombia. So the fact is that none of these countries was an OECD member at the time when India actually entered into an agreement with these. So this was the revenues contention. The next slide, please. Further, they said that they were not member of the OECD when the Netherlands treaty was entered into. They were not members of the OECD when these protocols were notified, but merely because subsequently they choose to become members of a OECD group, a group of nations, that cannot be the reason for applying these provisions contained in these DTAs, which are more beneficial to the Netherlands treaty. So just because of a subsequent unilateral action on the part of these nations, you cannot apply these beneficial provisions to the Netherlands treaty because of the explicit language of the protocol. Next slide, please. So now let's look at what the High Court had to say in this case. So what they said that a perusal of the relevant extract shows that it is an integral part of the convention. There is no separate notification required as far as the applicability of the provisions is concerned. They placed reliance in the case of Styria, India, where the court had held that this is an integral part, and there the court was looking into India-France TTA, which is paramateria, or the language is similar to ones which is contained here in the Netherlands Treaty. They also relied on the commentary of Clausvogel, and which said that in some cases there are other completing documents which are attached to treaties. Legally, they are part of the treaty and they have binding force equal to that of a principal treaty. The next slide, please. They said that this clause, which incorporates the principle of parity between Netherlands DTA and DTAs executed thereafter only if the following conditions are fulfilled. First, the state with whom India enters into a DTA should be a member of the OECD. Secondly, India should have in its DTA agreed to a rate which is lower or a scope which is more restricted than the Netherlands Treaty. Now, upon fulfillment of these conditions, from the date on which this DTA with India comes into force of this third entity, then the same rate or the scope would apply in the case of Netherlands Treaty as well. The next slide, please. However, then they departed from the clear language of the protocol to say that in some cases there may be a gap that between the date when the DTA is executed and when the third state it becomes a member of the OECD. In that situation, how you have to read this DTA is that you can start applying these beneficial provisions from the date the third state becomes a member of the OECD. What they said here is the word is, as we had seen in the initial slide. It describes a state of affairs that should exist not necessarily when the DTA was executed, but when a request is made for the issuance of lower withholding certificate. So here there is a marked departure, and this is perhaps a liberal reading which they've done here. Now, the best interpretive tool which they said that you could apply here in understanding the treaties is how the other contracting state is interpreting these provisions. The next slide, please. So they noted the contents of decree issued by Netherlands. And now please note, this is a decree issued by the Ministry of Finance, and we'll discuss about it a little later. And they said that clearly Netherlands has interpreted the protocol in a manner that a lower rate would be applicable from when Slovenia becomes the member. So they felt that this approach, it aligns with the concept of common interpretation. And this is something which is well recognized in the international law. The purpose of two tax treaties is to allocate the tax claims equally between the contracting states, and that can best be achieved if there is consistency in the way both these states are interpreting the provisions of the tax. So they say that there has to be consistency in interpretation of the provisions of tax authority and the courts of the concerned contracting state. Next one, please. So while interpreting international tax treaties, so here they are basically relying on the Azadi Bachao case to say that you do not apply the rules of domestic or municipal law, because the international treaties are negotiated by diplomats and not necessarily by men instructed in law. Therefore, their interpretation is liberated from the technical rules which govern the interpretation of domestic or municipal laws. So the core function of DTA is to aid commercial relations and between the both contracting states in respect of this. So therefore, they quashed these two certificates and they issued instructed that a fresh certificate with a 5% rate be issued. So this was the decision. We'll go to the next slide. So there are two basic important things about this ruling. One is regarding that the automatic trigger. Now, in case of automatic trigger, it is not that in all treaties it is a situation of an automatic trigger. For example, if we take a case of the Switzerland Treaty, this is the current protocol which came into being in 2011. So what it says is there are two aspects to it. If you look at the first part, it says in respect of a rate lower or provided in this agreement, then there is an automatic trigger. There is no need to wait for a negotiation. However, if you look at the later part, in respect of scope, if there is a restricted scope, then what it says that Switzerland and India shall enter into a negotiation without undue delay. So therefore, the principles that have been laid down in this particular decision, one has to carefully see as regard the the self trigger, that whether the language of the protocol supports this. For example, there was a case earlier in case of Torrent for India-Switzerland tax treaty. That was before this new protocol had come into being. That said that in that particular case, both the rate and the scope required a negotiation from the Indian side. So there they basically said that you cannot import anything from outside unless and until there is a notification. But this is the current situation where the protocol has been split into two parts. Similarly, there are other treaties, for example, the Finland treaty, where again there is a difference in language. Also, this decision basically also relies on Styria decision. The Styria decision has also talked about an automatic trigger, and this decision of Styria, Delhi High Court, is currently before the Supreme Court. So we need to wait for a final verdict on that particular one. The other aspect on the exact how to read the particular protocol. Now, in this case, there is, yes, indeed, a departure from the liberal reading of there's a liberal reading from the court of the express language. Now, all these three jurisdictions, they became OECD members much later. Now, one of the important aspects of treaty interpretation is also that you need to look at the intent of the parties at the time these DTAs were entered into. So it is difficult to consider that India at that time, while entering into these DTAs, would have envisaged that maybe going after 5 years or 6 years, these entities, these jurisdictions would also become OECD members. So it is difficult to visualize that would have been thought through at this particular point of time when these DTAs were entered into. And also these were probably based on the factors relating to these particular DTAs. Maybe the quantum of transactions you have with Slovenia, Lithuania, or Colombia, that would have played an important role. There could be other set of factors. Now, had these entities been an OECD entities, India knowing whether, that I have other treaties which say that in case I enter into an agreement with another OECD member, then through the MFN clause, these similar benefits would be given to these OECD member countries also. Would India actually have agreed to a rate as lower as 5%? That is a question. Was the intent of the government really so? Does the unilateral action of a country at a later point of time change the interpretation that can the benefit of this interpretation be taken? Now, another aspect is, yes, one can say that OECD does talk about an ambulatory approach. But then what would be, and perhaps that would be the answer if this was a reverse situation. Now, consider a situation where the entity would have been an OECD entity when the agreement was entered into. For example, Slovenia was an OECD entity at the time the agreement was entered into. But when we are applying this particular protocol in say 2021, Slovenia is no longer an OECD country. How would you have dealt with a situation like that? Would you have applied a similar analogy and then denied the benefit? If you follow an ambulatory approach, then perhaps the answer would have been yes. But again, there are conflicting views on whether treaty interpretation one should do an ambulatory or a static approach. Also, the extent to which one should rely on the analysis done by another country. Now, if you look at this situation, this decree that's been given by a finance ministry of a finance officer of the Netherlands jurisdiction. What exactly is the validity of this decree there? Is it something like a CBDT circular which is binding on the tax officer but not binding on courts? Does one need to look at something like that? Is it of any relevance? Also, when we talk about, this approach that this has to be in line with what the other country interprets. So which court do you look at? There might be a one-off decision of a court which is there, which may not align with all the other decisions there. And what is the level of that court? Is it when the Supreme Court here in India is deciding something, does it need to look at the tribunal decision of another jurisdiction? Or should it just only look at something which is a verdict by the apex court of the other nation? So what is the level of the jurisdiction in that particular jurisdiction? I think to my mind, that also is a significant factor. And the extent to which you rely, for example, this Netherlands decree, it also says that India does not have, this rate will not apply to the DDT provisions. Now, we have had cases in the recent past which say that even for DDT, the lower withholding rate of in the treaty should apply. If we were to stretch this ruling a little further, does that mean that in all those cases, since the other country has said that DDT is not a tax on dividend, and therefore, the Indian courts also have to take a view that no, DDT, then the decisions should they take that into account, or it is the other way around, since the courts in India have said that no, DDT is also somewhere where the dividend distribution tax also you can apply the withholding tax rate. Is this decree incorrect to that? Are they also not in a conflicting mode? Are they not following this approach of consistency? So various factors are there. Switzerland also, for example, I just saw that a few days back, another such memorandum or a decree from the Swiss government is also there, which also says that the rates that Lithuania has followed of 5%, the same should be followed for Switzerland treaty as well. But they've given a caution that if India does not reciprocate the similar thing, then we can relook at it. So I think when we talk about this approach that they're talking about, perhaps there's a little bit more thought to be given to that, which at some point the court has also indicated that you have to do a review and then assess. But yes, an interesting decision which has come at a time where this issue was coming up, and also you can obviously extrapolate this verdict to cover other cases of MFN clauses. For example, the rate, in case of interest, royalty, or FTS, this similar the ruling from this you can extrapolate and apply similar principles in the case of these other situations as well. So I think that's it from my side. Any other questions? I'll be happy to take them up.
Madam, may I ask, sir, with the permission of chairman, sir, may I ask one question?
Yes, sir. Please go ahead, sir.
Yeah. Madam, the India-Netherlands treaty was originally came on 1989, 27th of March, 1989. And after that, it was amended through the protocol, through the notification number SO693, dated 30th August 99. And the reason for giving this amendment was mentioned in the notification itself, that after this treaty, India-Germany treaty has signed, India-Sweden treaty has been signed, India-Swiss treaty has been signed, and India-US treaty has been signed. And therefore, on all these cases, the rate has been reduced from the earlier it was 15%, now it has been 10%. So in the case of the participating dividend, the rate has been reduced to 10%. So their 10% will apply. However, I just want to know whether at that time, when the earlier notification was issued, whether the similar type of decree was issued by the Netherlands at that time. Because right now we are relying more on the decree which has been issued by the Netherlands government here, and the court is going for the common interpretation on the Netherlands decree here. So first, yes, please.
So here in this case, this Netherlands decree was there in 2012. This had come about. And it says that from the day Slovenia becomes an OECD member, we should give that. Now, there are two aspects to it. In this case, Lithuania and Slovenia, the 5% rate is applicable only in the case where the 10% participation is there in the stake in the capital is there. Whereas in case of Colombia, the rate is 5% irrespective of this limitation. So in all these cases. So if this is to be followed, then typically the Columbia is a better proposition, and then you can apply in all cases. Now the question is that in this case, there was a specific notification issued in India. So what was the need for that notification if this protocol was on a self-trigger mode? So this issue, I think if I remember correctly, has been dealt in the ITC case, where they said that this is primarily on account of, this is more of an abundant caution mode. So to my mind, considering the other decisions on this issue, the language of the treaty becomes important. So here, if you see that if it is something like Switzerland treaty, which says that you need to enter into a negotiation, then it is not on a self-trigger mode, then you have to wait for the notification. In fact, if you look at the Netherlands decree, in respect of, I think, the P profits, they say that, you need to wait for a notification. But it is only as regards this in the dividend part that they say that this is on an automatic mode. So in fact, that country also is interpreting it in a particular way. So I think the language of the treaty is of import. And I think after Styria, after the case of this particular decision, it seems that till there is an adverse decision by the apex court, this may be a reasonable thing to take, that no further notification required, at least in those situations where the language of the protocol does not support it.
But whether the Styria case had been filed, had been appealed by the revenue?
Yes, it is appealed before the revenue, before the High Court, Supreme Court, and I don't know, I could not find about Concentrix, but I feel that this might also go. I mean, this is a big departure, though we were not really able to figure it out, but I'm sure this must be on the way too.
Oh, Madam, one question I'm taking from the chat box here, that is the Mr. Avni Sarora has written here, whether on the date of India-Netherlands DTA was entered, was there a DTA with the OECD country which had lower rate than the 10%? If no, then how should we interpret the term each, whether the term is a prospective or retrospective here?
See, the court has mentioned that this is something which can be prospective also. It is not a present tense, it is not a past tense, and it could relate to future as well. But as far as some other decisions also is concerned, there are different ways in which the term has been interpreted. But it is now more of a context of treaty interpretation, as the apex court itself has said that it has to be read the way a diplomat would have written. It's not written by lawyers. So is this departure that they're talking about? But if we also look at it, then in Ram Jethmalani's case, Supreme Court has also said you should not read a treaty in a manner that you make certain portions of it redundant. So the question mark here is that have you made certain portions redundant in this case? And if you say, it says that is a OECD member on the date, when this is notified. So if not the day Netherlands treaty was entered into, but at least perhaps the literal reading suggests that it should have been an OECD member the day the treaty was entered into, because at that point of time, the intent of India would have been that in most treaties, the rates are 15% or 10%. That if in this case, Slovenia is an OECD country, I am entering into a contract at say 5%, but this, knowing that I have MFN clauses and others, this will have a trigger effect on all the other OECD treaties. Was that the intent? Is that an issue? As far as the question on were there any other OECD things as well at that point of time, I don't recollect the dates. The OECD, like US has been an OECD member right from date one. UK has also been there. But in most of these cases, perhaps the scope was the issue. There was reduced scope, but I'm not really sure about which all countries were there prior to. But I think few of these countries have been an OECD members from a very later point of time. But as I said, protocols, there is no limitation on the number of protocols. You can have it at the time when you enter into an OECD with an entity, or it can be at a later point of time as well. So these changes are then interconnected, that if one enters into an agreement with an OECD country at a later point of time, then India perhaps would think through that it impacts all the other 34 OECD countries. So am I ready to give this concession? That's just a thought. And I think before this decision came, perhaps my thought process was I was reading it literally. And I had opined that no, in this case, you should be cautious. But now that we have a Delhi High Court decision, I think the taxpayers who do want to take a benefit of it, they could try it out with the the informed decisions can be taken.
Now it's to chairman, sir. Yes, sir.
Yeah, ma'am, I have one question. In paragraph number 17.8, Delhi High Court has heavily relied on the common interpretation. They have stated that it applies in the private international law. But I have not come across any decision, whether of this country or any other country, whereby at the time of interpretation of double taxation avoidance agreement between these two countries, this principle has been applied.
So, sir, that's the same
Even
with me.
after looking
Yes.
at the class Vogel, sorry to interrupt. Even after looking at the class Vogel commentary, it is also very guardedly saying that
Yes.
this may be applied in the domestic in the double taxation avoidance treaty, but it did not suggest that it should be applied overriding the other interpretation principles.
Right, sir. I agree to that. Even I have not really come across. And while we were, looking at this particular, we also thought through to look at it. We could not really get hold of anything. But then also there was one line there which was mentioned in clause Vogel that said that, you have to apply it with caution. You have to do your own review. So as I mentioned in my earlier this thing that, is it something like, can you say that this is a unilateral act? Was it something, do you equate it to a unilateral? If this decree is taken, would you say that this is actually a unilateral act also from the Netherlands? Because had it been a interpretation of the government of India, perhaps something similar like this could have been issued by. So that's just one thought that comes to mind. The other is, of course, yes. You also look at the words given in the treaties that if there's something which is contradictory, which is not defined, then you probably look at the domestic law applying that particular treaty. Now, in that is the situation. Yes. So in that situation also you may have two different interpretations, and then the map route is available. So maybe the court was trying that we don't go to the map route and we resolve it in this manner only. But yes, you're right. It is a newer concept which also we've not really seen too much. Let's see how it evolves.
I think court did not want to consciously go to Article 3.2.
Yes.
After reading this decision, it appears.
Yes, and I think it was beneficial reading. I think it was just beneficial reading.
And second thing is that when we look at the common interpretation, there is a decision of Netherlands Supreme Court versus South African Court, where the South African resident challenged before the Netherlands court about the dividend taxation, where there were the treaty involved as Netherlands, South Africa, Sweden, and South Africa, Kuwait at different point of time in the same manner. The Netherlands Supreme Court held in favor of the South African SSE. When the Netherlands resident approach the South African court says no, despite there being a Supreme Court decision of the Netherlands court, we do not follow that, and we will give our own decision based on our own domestic law.
So that
was the ordinary meaning.
Yeah, that was yeah. So that is how
Delhi High Court. Yeah. And Delhi High Court, believing a circular issued by a Netherlands tax authorities for deciding that yes, this is the judicial view of the Netherlands courts. It's like that's, I think, very dicey.
So that's I think how the honorable court felt at that time. So, but as I said, that we need to see how this pans out at the Supreme Court level, because considering dividend is going to be a big thing in future, I'm sure that there's going to be more clarity on this coming. But yes, till that time, you can experiment with this.
And third question, when you look at the dividend dividend received by the Netherlands companies from India, it must be in hundreds of thousands of crores. And if you look at the dividend received from by an Indian resident companies from Netherlands, it must be a very minuscule amount. The court did not look at this economic factor, which is one of the most crucial factor at the time of negotiation of treaty. Now, the Netherlands entity, Netherlands tax officer or tax authorities have issued one circular. They said that Netherlands is also going to give 5%. What does it matter? The court has not looked into the economic aspect of this decision at all, which is also the paramount consideration when two governments are negotiating a treaty.
Very right, sir. And in fact, if you extrapolate that, the similar thing when India would have entered into Slovenia treaty and Lithuania, they would have visualized that what is the quantum of dividend that is involved here. So as I mentioned, they intended that this will flow to other OECD countries, then maybe a different thought process would have gone in that. So it is difficult for the policymakers also to visualize that, say, 5 years down the line, this country will become a OECD country, and therefore this benefit will flow automatically there. So whether when you look at intent, which is also one of the important facets of treaty interpretation, is that captured? That could be one argument. But so far, what the court has said, going by that, it seems that, following the ambulatory approach, the beneficial approach, the common interpretation approach, the fact that the Supreme Court has said that you do not interpret treaties with commas and semicolons, do a plain reading. So this is what flows from here, that this is how you need to interpret it today.
Ma'am, one more question here. How do you see the treaty interpretation here? Treaty has to be interpreted in a good faith as per the VCLT. Here the treaty is, their law is, here the court say the treaty has to be given for the common interpretation here. So how to reconcile the common interpretation with the good faith here?
So I think their interpretation perhaps is that both the entities, both the jurisdictions perhaps wanted a similar interpretation. Perhaps that is what the intent comes out, because good faith, again, it's a they say it is dependent upon the context. It is dependent upon so many other factors, plain reading, context. So it has to be read in various manners. So I think if it has to be justified that way, then perhaps what is context? That's also very ambiguous terms. So whether the context here is how the Netherlands entity, the Netherlands tax officers have interpreted or there. So perhaps that is what went inside at that particular point of time. Perhaps the notes that they shared at that time had something which reflected this. So it's difficult to comment on what went on, what was the thought. But yes, good faith has also subject to so many other caveats.
Okay, ma'am. Harpreet bhai, may I request that if any question is required, just one more question, Madam come. I have received one question here, and that question is to Saurav sir. It is not to you. May the judgment of the Supreme Court be applied to case where there is no treaty or SSC is ineligible to apply treaty due to PPT, that is the principal purpose test, or in MLI, or GAR, or non-furnishing the TRC certificates?
Yes, that's a very pertinent question. If the SSC is not eligible for the treaty benefit, then I doubt this Supreme Court case will be of use, because then the recourse is straight to the Act, and the Act has a bigger reach that has already been established by the Supreme Court. So if treaty is not available, then I think only the Act will guide the taxation.
There's one point, sir. In the case of the software royalty case, para number 168 8 especially says, given the definition of royalty contained in Article 12 of the DTA mentioned in the paragraph 41 of the judgments. So the last para says that this judgment is qua the 41 TT, para 41, and para 41 there are 18 TT which has been mentioned in the para 41. So this judgment is qua the for those 18 TT which has mentioned in the para 41. It is not for those TT which has not been mentioned in this part here. So para number 168, sir. Para number 168, last para.
Yeah, I missed that. I missed that part. Which one?
Para number 168 of the judgment, sir.
Right.
I'm just reading the para number 168 of the judgment, which says the conclusion. Given the definition of royalty contained in the Article 12 of the DTA mentioned in the paragraph 14 of this judgment.
Okay.
So, and for paragraph 14 talks about the 18 judgments, 18 DTA.
It is okay. Yes.
So it is not on the paragraph 41, but 40 itself here. Okay, sir.